Welcome to TheoTrade. This is Don Kaufman. It's November 23rd, 2018, and you are watching the TheoTrade Weekend Update. Here we are. It's a Friday afternoon. It's Black Friday, of course. That is the shopping extravaganza following Thanksgiving. Well, we'll see how really effective this Black Friday is going to be when we come in, of course, to early next week. Push all that aside. Bottom line right now inside of markets moving forward, we got compounding issues, people, and that's what I want to cover not only on this video portion, but we're actually going to show you some definitive evidence when we start to look at the charts and even more importantly and more appropriately, some quantitative data. All right, let's get down to it, because I think that's a pretty bold statement when I say, you know, we've got compounding issues. First of all, let's start with the S&P 500. So there was an expected move this past week. And again, this past week, we only had Monday, Tuesday, Wednesday, and a half a trading session, of course, on this Friday. So in 3.5 trading sessions, we were supposed to move about $47. All right, that's the expected move. That's based on the options premium, of course, from last week. So it's projecting about a $47 move. If you guys tune into videos kind of week in and week out, you'll know that I mentioned, I'm like, I wouldn't sell anything on the weekly basis. I thought that expected move was, first of all, I thought the expected move was incredibly tight. We were seeing $40 and $50 moves each day in the previous week. But again, I elaborated upon not selling any premium in the near term. Now, the SPX was supposed to move $47. What did it actually move? About 104. So we blew outside of the expected move. And when I talk about compounding issues, again, one of the definitive things we look for is what we term inefficiency in the marketplace. Options market said we were supposed to move 47 bucks. We didn't do that. We moved $104. So you're starting to get, you know, the seams of the market are getting pulled apart. Now, moving forward this next week, okay, and that kicks off, of course, November 26th. This next week, we've got just about a 60, okay, $2 expected move. So the volatility, again, it's not rocking. Like, you know, you're not feeling the fear inside of the marketplace. So again, one of the first issues that we're going to raise is that we're outside, of course, the expected move coming off this week of trade. And that could be a sign, again, the seams in the market starting to get ripped apart. The next one, financials. Well, the financials got hammered this week, and we've been talking about this literally ad nauseum. You know, 2650 is this, you know, almost the Maginot line for the financials. And the financials closed, well, under that. Not well under that, but under the 2650. Anything under 2650 is, in my book, it's definitively bearish for the overall S&P 500. Speaking of the overall S&P 500, for those of you that follow our gravity points, 2626. I'll show you guys that in just a minute. You'll see exactly what I mean. Now, moving forward, another big, huge, really issue. It's coming into oil. Oil gets decimated in the last few weeks of trade, but this week was really, it was unprecedented sell side activity. It's literally wiping out a number of oil traders, but that, again, it's not favorable to see some traders get eaten alive in the marketplace. It's, you know, it's reality in the market. But again, these are real economic issues. So what are some of the economic issues with oil? Like, let's just state the obvious, is that when you see oil selling off like this, it could be indicative of global economic slowdown. Could be. But you know what? You're not going to know that until it's literally too late. And I don't even want to make that argument. All right. The bottom line with oil and the compounding issue is everything about debt and really the credit markets. If oil's getting whacked, there are a ton, okay, of firms involved in the energy business that are using junk debt to finance, for example, drilling. I mean, I can go on all day about all of the junk debt that is really integral to what you see in terms of the energy sector. And with oil, you know, in the low 50s, it's not good. It's not good at all. And we may actually start to see some of this debt really start to surface. In fact, we'll look in a minute at some of the junk debt in the marketplace. Moving on from there, what I'm also going to show you here momentarily is a sector comparison. And what the sector comparison is going to display is the marketplace as a whole okay, is not only obviously coming down. I mean, again, let's not state the obvious, but you're starting to see the Nasdaq descend in a very rapid fashion. Again, I'm going to show you that here momentarily. It's going to make a lot more sense when it's really placed in context. But again, we have a number of very key issues that are really starting to compound. And this is something that, well, we didn't have necessarily in October. What I'm saying is, the risk was perceived. The risk was caused by, the Fed is after us, right? The Fed is coming and the interest rates are going to rise, and the fears, yeah, well, now those fears have to be realized that there are real economic issues starting to surface in this marketplace. So with that, before we jump into the charts, we have this very special offer for you. As mentioned moments ago, it's Black Friday, and we at TheoTrade have an unprecedented offer for you, $799 for an entire year of TheoTrade. Now, you may not be a member of TheoTrade. That's okay, it's $799. You may already be a member of TheoTrade on a month-to-month. Guess what? $799 to get you a full year. Or maybe you are a member of TheoTrade and you're 6 months into a membership. Well, guess what? For $799, you can actually tack a full year onto the end of that 6 months. So again, it's $799. It's an unprecedented offer. What does it give you access to? Everything. What's everything? We have over 75 archived classes. All right. We do at least one class per month. Although most months we actually have 2, sometimes even 3 classes inside of each month. All of that added to the archive, and of course you have access to all of it, for the additional year. What else do we have in there? Well, we stream live about 6 hours per trading session, and everything is archived. In addition to that, we have trade ideas that we email out, but an annual member also receives text messages. So we're actually going to text message you if you're in the US or Canada. What else does this have on it? As I said, access to everything that we do, email support. You ever need to get a hold of us, support@theotrade.com. Did I mention we have 57 proprietary indicators on the site? It gives you access, again, to everything that we do and everything that we're going to do for the next year. Now, if you would like to enroll for this, we have a very definitive deadline. Monday. This is Monday, November 26th. It's considered Cyber Monday, midnight Eastern time. We are pulling the link off. We also have a very limited number, of these slots. We don't want 3,000 people signing up at $799. It's an extremely limited number. So get in early. We've had a great response already. If we shot you out an email, the link to enroll, is inside of that email. If you are watching this video on YouTube, well, the link is just below the YouTube video. With that, I want to thank everybody for coming here to TheoTrade. Again, enjoy what has become an unprecedented offer. Sign up right now at $799. With that, well, let's get to the charts. Let's get to some quantitative data. To the charts we go. Let's get right to it, looking at the S&Ps and specifically the S&P futures hitting to the button 2626, which happens to effectively be one of our gravity points. And of course, we're closing just $2 off our 2626 level. For those of you that are a little newer, don't necessarily know the gravity points, what they are, where to find them. First, I'm going to back up here to a 180-day 4-hour chart. And the gravity points that really come into scope right here, right now, are 2626, 2682, but hidden off the bottom of your chart, also very, very critical, 2575. Now, again, these gravity points are derived from looking at areas of kind of concentric risk amongst mass trading firms. Bottom line with that, it takes a huge amount of regression analysis to be able to pull these particular gravity points out. Clearly, they have mass statistical significance. And I can't stress that enough, because in some of the recent videos that we've done, we've actually showed the markets having either a low or a high or closing directly on these particular gravity points. So a question that's going to come up a tremendous amount in just the next few days or few weeks of trade, what if we actually break below the 25.75. Well, quite frankly, I don't have any levels below that because if I snap here to a three-year chart, there hasn't been enough trade, okay, and enough trade data anytime in the last year to kind of substantiate anything below 25.75. The moment we start to break below 25.75, that's when, once again, the hunt is on. By the way, these gravity points, okay, this is not something we put in play in the last couple of days. This is stuff that's actually been in place, okay, and being traded off of since the beginning of the year. Of course, we had a gravity point to the upside that was added much later in the year. Nevertheless, most of these gravity points, you can actually see the date of origin. For example, here, the 28.42 all the way back in January, okay, down to the 25.75, also set in early February. Now, with that, let's put aside some of the gravity points. Let's actually cruise over to the SPX because the SPX, as I was mentioning, displayed, if we will, this degree of what we'll term inefficiency. And I think this is of critical importance when I talk about efficient markets and inefficient markets. I'm measuring that not based necessarily on implied volatility or even historical volatility, but the effectiveness of options pricing on a week-to-week basis. Okay, and if you take a look again at what occurred in this last week of trade, here happens to be again that's this central point right there. Okay, that central point is the beginning of the week. We were looking for $47 higher or $47 lower. What happened? Well, effectively, we had approximately just over, okay, 104-point move inside of the SPX. Now, you would think, okay, let's not get crazy over here, but you would think, given the fact that we had just had a 3.5-day week and you have this 100-point move to the downside, okay, what would you think that the expectations of risk would be moving forward? Okay. Well, again, I would probably think like, wow, they would really expand the risk out there. Well, when I say expand the risk, I'm saying the expected move. Let's close up this left side bar and really get down to it. So November 30th happens to be next Friday. So here we are on the 23rd, and the 30th is next Friday. And by next Friday, what are we expecting? And you got it right there. It's about a $62 move. I'm just rounding it. Get over it, engineers. It's 5 cents, right? It's a $62 move on a 20% implied volatility. How ironic, given the fact that we just had, well, $100+ move in 3.5 trading sessions. And that's worrisome. And I'm going to reiterate once again, don't sell premium in the short duration. We're not there yet. And when I say we're not there yet, I'm saying premium selling, okay? We're starting to warm it up a little bit, but there still needs to be a period in the market, okay, that's going to have absolute, what I would term, shock and awe. People have to be scared. They have to feel the fear. Premium sellers have to get knocked back into a cave and never want to come out again. And then, okay, then we will have some great premium selling opportunities. One thing that I want to stress on this weekend's video, even at risk of taking a little bit too much time on this video, but I think it's so important that just people don't get. If you look at like volatility studies and just cruise up to historical volatility, what historical volatility is, it's how much the market is actually moving. Now, it's past tense, right? So it's averaged over 20 days, and it's the annualized standard deviation of past stock price movement. And the point that I want to make with the historical volatility here in the SPX, okay, it's kind of over the last few weeks, right around about 22%. By the way, that's 22%. People get kind of a little thrown off, okay, but make no two ways about it. Okay, the historical volatility is right around 22%. So that's actual price movement in the market is about 22%. I'm just averaging and ballparking right now. But if you take a look at the week to week, the implied volatility is only like 20%. So what I'm saying is the juice ain't worth the squeeze. People sell options. Why? Because we're not supposed to move $62. The problem is we're moving much more than's expected. And I cannot stress this enough. By the way, it's not just in the index products. You got to be careful. Go take a look at Amazon. All right, want to see something really wild? Go look at Amazon. And more recently, you've got the historical volatility. This is actual price movement again at 65%. Oh, it's coming down. okay? It came down a little bit here, but it's 65%. And with 65%, then you start looking anywhere on this right-hand side of the screen over here. And on that right-hand side of the screen, do you see 65%? Because I sure don't. Okay, so you're not getting paid, right, to take the kind of risk that you'd be taking trading into Amazon. So those of you that are running out there like, there's volatility, let's sell it. Okay, all right, put it away for just a little while, or go out there with very, very minimal amounts of risk. Okay, let's move on. As I was mentioning, kind of in the video portion of this, got a lot of issues, and again, a lot of compounding issues in the market outside of individual equities over here. Some of the compounding issues, as I said, the SPX cracking the expected move. As I said, it's a degree of inefficiency in the marketplace, and when you start getting a little crazy like this, okay, markets are ready to break at that point. So one thing I just want to display to you here in the spiders, and I'm going to use the spiders, okay, and I'm just going to open up a 1-year chart. We are getting towards the lower end of the range on the year. Also, on a year-to-date percentage, the spiders are now down 2%. Neither here nor there. Okay, what kind of looms inside of the spiders? You know, where a degree of concern for me is when you start opening up an area like a 3-year chart and recognizing you're like, wow, we're just getting going over here. Okay, that sell-side activity could take us much deeper. However, okay, the point being here, when I'm talking about compounding issues, we are towards the lower end of the range. And could there be a break this very next week? Absolutely. Nevertheless, I would fully anticipate some wicked rip-your-face-off rallies in here. We've had a lot of down trading sessions. Volatility hasn't really picked up all that much. But again, look for it early this next week. Okay, early in the week, maybe some retail sales numbers come out that people are going to be like, all right, okay, be careful. The rip your face off rallies, you got to sell into that. But okay, put that aside. One of the other compounding issues happens to be the financials. Now, I'm going to zoom in tight to the financials over here. As I said, the financials broke, okay, under this 2650, and I cannot stress that enough. By the way, the 2650, this is not something new. This is something that I've been looking at. Again, let me open up a 3-year chart and kind of explain to you how torturesome this 2650 has been. This is again, this has been a very long duration that we've been looking at this particular level, and effectively anytime in recent history that we've been under this 2650 in the financials has actually been bearish for the entire S&P. So you need to know that right now, I was just mentioning the spiders, and they look like they're, in the S&Ps look like they're ready to crack to the downside. Well, this is going to add some definitive evidence to that. The financials go, we're all going to go, right? And I cannot stress that enough, right? We know that technology is under duress right now. This is the monsters of tech, but you can look at the Nasdaq. You want to look at, Netflix. I mean, some of these stocks have fallen now. It's getting huge, from 380 all the way down to what, 250 on the button. Okay. If you look at a year-to-date percentage, though, let's just put it in perspective. It's still up 28% year-to-date in Netflix, and over the last 5 years, it's just, again, we're starting to make a dent in the market. But it's still up 417%. So when you look at this and you think to yourself, we can't possibly have any more sell-side activity. Yeah, well, guess what? Okay, open up a 3 to 5 year chart and tell me that, right? Because again, markets, they are right on that edge of a break to the downside. Now, the other compounding issues, big issue inside of the Dow. Let's actually cruise over to the Dow for just a moment. Okay. So I've mentioned the Dow quite a bit, and the Dow has now come down to 24,000 in change. And it's not often that I kind of bring up the Dow and then mention an individual stock, but the Dow is in trouble not because of the Dow. The Dow is in trouble because one of its key components has now broken to the downside. So the Dow has now correlated with the S&Ps. That effectively means the Dow is down 2%, the S&Ps are down 2%. The issue with the Dow isn't so much the Dow. The issue with the Dow happens to be none other than Boeing. Okay, Boeing is still up 5% on the year, okay, but it's off, again, a very recent high of almost $400. Okay, even more recently, in just the last, 3 weeks of trade, you've had a 370 print, okay, all the way down to, again, roughly a 312 print where it kind of settled out in today's trade. These are some vast moves. Why am I so concerned about Boeing? Because Boeing, being a $300 product, every point that Boeing moves is a huge ding inside of the Dow. Okay, Boeing is the largest constituent to the Dow. It's going to have the most influence. Again, the Dow could be in very serious trouble at this point in time. Moving on from there, okay, then we're going to get to a couple of trade ideas. Moving on from there, oil. I don't want to state the obvious. Listen, if you haven't looked at the oil chart, look at an oil chart. Okay, it's getting absolutely hammered. Oil, though, is going to kind of reverberate into what I would believe is going to be more of a debt or what I would term a credit issue. Okay, I don't want to make this like, okay, it's an economic slowdown, because that's hindsight. You know, it's kind of like a recession. Whenever you're in a recession, they don't tell you until, like, you know, you're almost coming out of the recession. What good does it do to state like oil could slow down the economy? Listen, it's going to have a drag on the economy. We know that. All right. Why is oil, you know, tanking like this? I can give you 50 different reasons that we think oil's coming down right now. Could be oversupply, or could be a global slowdown, or, okay, doesn't matter. What I need to know is what the impact of oil is going to be. Okay. And I think the place to look for that, again, take a look at the slide in oil. It really kicked into high gear in early October with the rest of the marketplace. And, you know, you kind of figured oil was just coming off with the rest of the marketplace, except its drop has become precipitously larger than the rest of the marketplace. The area I need to start to bring into focus, though, is junk. And for that, we're going to bring up the HYG. So HYG, which happens to be junk, also started taking a hit. In fact, there's some heavy correlations between the junk debt and, of course, oil. You know, this is not necessarily a trade that I'm looking for in HYG. I really want to elaborate upon that. Okay. We're on credit watch right now. That's all it really, okay, means. As long as the HYG is coming down, what it's doing, there's sell side activity in the actual paper, the junk debt, which is going to take the interest rates, okay, and they're gonna start to fly in junk debt. So you already have the oil market that's under duress because the price of oil. To compound their issue, okay, the debt that they've got to go out there and get is going to get that much more expensive. Okay, it's hideous. You know, looking at junk markets, you also even have to consider a place like Tesla. Okay, Tesla is actually being floated off of very, very high yielding kind of junk debt. So this is going to have an impact, though, to many, many firms. Not necessarily like, you know, your top tier S&P, but I'll actually mention a bunch of these names in the coming days in the TheoTrade chat room. So oil, again, is really on the forefront. We're on what I would term like credit watch right now. Hey, listen, all issues eventually end up. Okay, they don't necessarily start in the credit markets, but they absolutely end up, okay, in debt and credit markets. And this has to be watched very, very carefully. If you take a look at this on a 5-year, right, listen, it's not an unprecedented move, but it's starting to get, you know, we're getting a little scary at this point. No question about it. The last time the S&Ps were really getting whacked, okay, that was in right back here in early 2016. I'll remind everybody, right there, okay, that's when the S&Ps traded 1,800. Where are we now? Yeah, we're all the way up here. So, you know, it's a long way down, but it's not looking good inside of the credit markets. All right, another area I want to actually bring up and for you to consider. This happens to be none other than a sector comparison. You haven't seen me bring it up in a while, but there is clearly what we term convergence going on inside of sectors. So why am I bringing this up? Why the sector comparison? Okay, before I go too far into the sector comparison, I'm bringing it up because we've gotten quite good here at TheoTrade at kind of handicapping where some sell-side activity might be in the short term. For those of you guys who will remember, throughout the course of last week, I was bringing up underlyings like Coke. All right, we said short Coke. Coke came down. We brought up underlyings like Verizon. We talked about short positions in Verizon. Why? Because it's only a matter of time before the market starts to correlate. And I mean, look, like, it's Verizon, people. And we also made this point after watching, okay, Walmart fall. Walmart gets absolutely whacked. It has nothing to do with the earnings. Walmart gets absolutely whacked after, an amazing run to the upside. It was only a matter of time, okay, before, again, a number of these key products. And I can go on and on. We went through a ton of these individual stocks. McDonald's, we happen to have positions in McDonald's. You can see I'm working in order against this. Bearish positions in McDonald's, okay? But why am I now going into the sectors, okay? Because we're using, again, this kind of sector comparison to try to get a little bit ahead of the game. What I'm saying in this respect is that these sectors are starting to converge upon one another. Now, that could mean the entire market is going to fall down, okay? That could actually mean, again, bouts of volatility. But when I say convergence, okay, that is the underperformers are starting to converge upon the top performers and vice versa. Some of the top performers, look at some of the steep declines inside of here. Now, it takes a little bit of work to put this sector comparison together. This is something that we absolutely share here at TheoTrade. But all I want you to do is go over and kind of right click. That happens to be the XRT. That's retail. Granted, we've been short the retail sector. Right up over here, XLY, which is discretionary retail. Right in the middle over here, none other than XLV. What is it? It's healthcare. We found a strong point in the marketplace, and this is something that we're absolutely looking to short into, and it happens to be none other than right now, it's healthcare, and that's really kind of caught our eye. There are some positions that we're going to be looking for this next week, okay? Could be an XLV. XLV, if we bring it up on a year-to-date percentage, still up 7%. So it's drastically outperforming, again, drastically outperforming not only the S&Ps, but most of the other sectors. I mean, this is healthcare. This is not like technology, and yet it's still the outperformer, okay? What else could we look at? Individual healthcare providers like Aetna, which is up 13.65, or UNH, okay? Right now, UNH is probably top on my radar screen. Why? Because it's also one of the key constituents inside of none other than the Dow. And there, again, lies in reason that I was bringing up the Dow. So the Dow, its top constituent happens to be Boeing. Right behind that, okay, happens to be United Healthcare. If the Dow is going to fall, United Healthcare is coming down with it. There's no if, and, or but about it. United Healthcare, and people are going to make an argument, like a fundamental argument, yeah, healthcare is being used to kind of mitigate risk. We're going to put money in there because it's not going to be impeded upon if there's an economic downturn. Listen, got to put all fundamentals aside right now. This has to do with quantitative finance. And quantitative finance, right, is about correlations. It's about correlations, about correlation coefficients. And if the Dow is going to fall, we can take a look under quotes over here. This happens to be none other than the Dow and the constituents of the Dow. But if the Dow is going to fall, it's actually going to pull United Healthcare along with it. We're going to be looking, okay, to enter in positions on any upticks inside of United Healthcare early in this week. With that, I want to thank everybody once again for joining us here at TheoTrade. Join us all throughout the course of this week in the TheoTrade chat room. Have a wonderful holiday weekend. Bye-bye.